So next topic for this particular chapter is auditing the accounting estimates and related disclosures. So what are estimates? So every financial statements we use certain estimates to complete our financial statements. For example, allowance of receivables, it's based on the estimates. To reduce the inventories to net realizable value, again based on an estimation. It's an estimation that the value of inventories would be this much. So that's an estimation. Allowance for receivable is an estimation that what will be the amount, what will be the value of receivables the receivables might not pay to us. Useful life of depreciation again is an estimation. Warranty provisions again an estimation. So what is the risk with respect to an estimation? Because estimation is something that can easily firstly manipulated, or they can get it wrong as well. So because of the estimation might impact in such a way that, for example, they will go for a understated allowance for receivables, which means your assets will be overstated, expenses will be less. So overstatement of profits could incur because of the estimation going wrong. So here estimation is not a true evidence. We cannot collect evidences, true evidences or strong evidences for estimation, because obviously, as the name says, it's all an estimation. We cannot specifically say this will be the amount, or this will be the amount that we are going to assess on this. So hence the estimation or the allowances etc. will definitely will be impacting the statement of profit or loss as well as statement of financial position if they are marginally having certain differences. Further, in terms of the estimations, the clients, the management may also look to manipulate the financial statements. To give you a simple example is manipulating the useful life in terms of depreciation. So let's say, for example, if the profits is very less for the company, what the management would do is reduce the useful is to increase the useful life. So if it is from 10 years, if they increase the useful life to 12 or 15 years, then the depreciation expense will drastically reduce. So when the depreciation expense drastically reduce, the profits will increase. So in that case, the estimation which they are charging for the useful life, if they manipulate that, automatically it could lead to overstatement of profits. So management over the years, they would have, what they would do is to ensure their results are good, they will manipulate the estimation, because estimation is like they are taking a decision based on their reasonableness. So that always a factor is something that is considered over there. Also, in recent years, developments were considered in the accounting treatment for complex and volatile amounts such as financial instruments have led to the greater scrutiny over the approach of auditors when accounting for estimates. In financial instruments, there is a provision that is created for financial instruments. Of course, allowance for receivable is one. Another is called as expected credit loss. Financial assets have to be created based on a provision called as provision for expected credit loss model, and that provision is a very big assumption altogether. Now that assumption have to go for various reasonableness, and lot of judgment have to be taken into consideration. To give you an example, let's say a bank gives a loan to a customer. Now for the customer, what if he doesn't pay back? They have to create a provision. That provision have to be based on the strength of the customer, like whether the customer is paying back the money properly, whether the customer is have good credit rating, what is his strength, how far he will pay us back the money, etc. All those things. So based on that, his credit risk is also considered to charge for the provisions. So there is that credit rating, all of those is actually based on an analysis and an estimation. And because of this particular situation, the estimation have a severe impact on the financial statement, because the provision could change if the credit rating changes slightly itself, right? So if the customer is good credit rating, his provision will be less. What if his bad credit rating? His expected credit loss model, he will go from stage 1 to stage 2. So if credit rating deteriorates, the staging of the provision will also decrease. In that case, this provision have to increase. So estimation plays a major role in accounting now, and auditing the estimation is also trickier because there is no hard and fast rule, because management are allowed to take a reasonable call. And if management are allowed to take a reasonable call, our intention is to ensure that the reasonableness of the management's calculation and assumption. Second, the intention of the management. Are they trying to do any fraud? That skepticism should also always be in our mind. So as per ISA 540, when it comes to accounting estimates and related disclosures, so ISA 540 Auditing for Associates and Related Disclosure was issued in 2018, and it emphasized on the requirement to obtain sufficient appropriate evidence with respect to estimations itself. So the standard also requires the auditor firstly to obtain an understanding of the estimation. So before auditor starts to collect the information, the auditor have to obtain an understanding relating to the accounting estimates and the disclosure which are followed. What is the complexity of the estimation followed? Like it's in financial instruments, is it complex accounting? Is there huge subjectivity involved in calculation of the accounting estimations? Is there uncertainty, right? Is there uncertainty where there could be lack of precision by the management, and due to which the amounts could go or differentiate very severely? What are the inherent risk factors that could affect the estimation, which takes into account in the financial statement, should also be considered. Also, an understanding of the controls relating to the estimations in operations of the client should also be taken into consideration. So these are the 5 things the auditor need to focus on when it comes to auditing the estimation: the complexity, the subjectivity of the estimation, the estimation uncertainty, the inherent risk factors of the estimation, and finally the controls relating to the accounting estimations. These are the 5 things that they need to look for. The auditor should consider the internal controls relevant to assessing the accounting estimation a client could over the significant activities, such as systems oversight and governance. Like, are they involving any expertise like management for certain estimations? For example, in financial instruments, for assessing the for assessing the expected credit loss provisions, management do hire management experts who give opinion on the provisions they can charge based on the credit rating. So the credit rating and all, they keep up expert on it. So that is whether the management is going strong in controls with respect to the expertise of the expertise as well, or are they hiring an expert to involve to accounting the estimates, etc. Once the auditor have understood all these factors, they need to obtain sufficient appropriate evidences. Evidences could be from subsequent events, like for example, allowances for receivables can be based on the receivables, how much they have paid back after the year end. Subsequent to the year end, have they paid back any year end? What are the sales price? For example, trade receivable, inventories which are reduced to net realizable value, where inventories are reduced to net realizable value, where the inventories, what are the post year end sales price? Is that getting affected? If the post year end sales price have reduced significantly, then if it is lower than cost, then there could be a net realizable value. Review the management's own estimates and see if the test the management's estimation to see what is the underlying data they have used, process used by the management, what are the controls they have taken into consideration, have it gone for a maker and checker or review of the estimation have been done, whether the data have been assumptions of the data have been reviewed appropriately, complexity and subjectivity and uncertainty have been addressed clearly, etc. should be very clearly tested and has to be tested by senior management as well, like senior auditors as well, like not just the juniors but as well partner also need to review these certain criteria. Should there be evidence that management has failed to take account of estimation of uncertainty or management's point estimate cannot be relied upon, the auditor should consider developing their own estimate. So if the auditor feels that, okay, whatever the estimation the client have prepared, if the auditor are unable to rely upon that, then the auditor should develop their own estimation. They cannot rely upon the management's work. And auditor, after developing their own estimation, or after reviewing the work of the management, need to assess any variances between their work and the management's work. And there also must determine whether a misstatement exists with respect to the accounting estimate and whether the misstatement is material in nature. And if it is material, then the implication should be mentioned in the auditor's report.